The stock market has crashed 12 separate times since 1950 by 20% or more. Every single time it recovered. Every single time it went on to reach new highs. The investor who held through the entire history of the S&P 500, every recession, every crisis, every period of genuine, justified fear about the future of the economy, earned approximately 10% annually on average across the full period. The market itself, left alone, has never failed a patient investor. This creates an uncomfortable question that most personal finance content avoids asking directly. If the market itself reliably rewards patience over any sufficiently long horizon, why do most individual investors fail to capture anywhere close to that reward? The answer has a name in behavioral finance research, and it is not the market's fault. Dalbar's Quantitative Analysis of Investor Behavior, an annual study that has tracked this specific gap for over 30 decades, consistently finds that the average equity fund investor earns several percentage points less annually than the very index funds and mutual funds they're invested in, not because they chose bad investments, because of what they did to good investments after buying them. This is the single most expensive category of personal finance behavior most people will ever engage in, and almost none of it shows up as an obvious mistake in the moment. It shows up as a series of individually reasonable feeling decisions, protecting yourself during a scary market, pausing contributions during a tight month, borrowing against your own retirement account instead of taking on new debt, chasing the fund that performed best last year, each one defensible in isolation, each one quietly devastating in aggregate. This video covers 10 specific things investors do to their own accounts that cost more than any market crash, any bad year, or any economic recession ever could. For each one, the exact dollar cost is calculated using the same historical data and the same compound growth mathematics that make long-term investing work in the first place, so the cost of self-sabotage becomes as concrete and undeniable as the benefit of patience. Real quick before we start, if topics like this are your thing, make sure you're subscribed. And if you end up enjoying this video, go ahead and leave a like. All right, let's dive in. Behavior 1. Selling during a market downturn. This is the single most destructive behavior available to a long-term investor, and it is also the most psychologically natural response to watching your account balance fall. Here is precisely why it is so costly. A market decline only becomes a real, permanent financial loss at the moment you sell. Before that moment, a 20% or 30% drop in your portfolio's value is a paper loss, a number on a screen that reflects what your holdings would currently sell for, not what you have actually lost, because you haven't sold anything. The moment you sell during the decline, the paper loss becomes a real one, locked in permanently, with no possibility of participating in the recovery that has followed every single market decline in history. The 2008 financial crisis produced a 57% decline in the S&P 500 from its 2007 peak to its 2009 trough. An investor with $100,000 invested at the peak who sold at the bottom locked in a loss of $57,000, ending with $43,000. An investor with the same $100,000 who held through the entire decline and the recovery that followed saw their account return to its original $100,000 value by 2012 and continue growing from there, reaching approximately $420,000 by 2024 based on the S&P 500's actual total return over that period. The behavioral pattern that produces this catastrophic gap is well documented. Investors disproportionately sell near market bottoms, precisely when fear is highest and continued holding feels most unbearable, and disproportionately buy back in only after a meaningful recovery has already occurred, meaning they sell low and buy high, the exact inverse of the strategy that actually builds wealth. According to Fidelity's internal account data released during the 2020 pandemic crash, investors who sold their entire equity position during the March 2020 decline and remained in cash missed a recovery that returned the S&P 500 to its pre-crash level within 5 months and went on to gain over 100% from the bottom within 2 years. The fix requires no investment skill whatsoever, a predetermined, written commitment made while markets are calm, not while they're falling, that specifies you will not sell equity holdings during a decline, regardless of how severe the decline feels in the moment. This single behavioral commitment, maintained consistently, is worth more to long-term returns than any stock selection skill, market timing strategy, or investment newsletter subscription available. Behavior 2. Stopping contributions when the market drops. This behavior is less dramatic than outright selling and is therefore far more common and almost as costly because it eliminates exactly the contributions that would have purchased shares at their lowest, most favorable prices. When the market declines, the same monthly contribution buys more shares than it did before the decline, because each share costs less. This mechanism, dollar cost averaging, means that continuing contributions through a downturn is mathematically one of the most favorable things an investor can do, even though it feels emotionally like throwing money into a system that is currently losing value. Consider an investor contributing $500 monthly to an S&P 500 index fund through the 2020 pandemic crash. In February 2020, $500 purchased shares at the pre-crash price. In March 2020, with the index down approximately 34% from its February peak, the same $500 purchased roughly 50% more shares at the lower price. Those shares, purchased during the crash, at the depressed price, became some of the most profitable contributions in the entire multi-year investment history once the recovery occurred, because they were acquired at the cheapest point in the entire cycle. An investor who paused 6 months of $500 contributions during the 2020 downturn and resumed afterward ended up with approximately $14,000 less in their account by 2024 than an investor who continued contributing throughout, purely from missing the specific months when contributions purchased the most shares per dollar. The fix is identical in structure to the previous behavior's fix. Automate contributions so they continue executing without requiring a monthly decision, removing the moment of conscious choice where fear has the opportunity to interrupt the strategy. Behavior 3. Borrowing against your 401k. A 401k loan is marketed and frequently perceived as a relatively benign financial tool. You're borrowing from yourself, the interest you pay goes back into your own account, and the approval process is simpler than most conventional loans. This framing obscures the actual cost, which operates through a mechanism most borrowers never fully calculate. When you borrow against your 401k, the borrowed amount is removed from the market and stops compounding for the duration of the loan. The interest you pay back does return to your account, but it is typically a modest rate, often the prime rate plus 1 to 2%, far below the approximately 10% historical average annual return the same money would have earned had it remained invested rather than being withdrawn and slowly repaid at a much lower rate. The loan's true cost is not the $4,800 in interest paid. It is the approximately $18,400 difference between what the money would have earned in the market and what the 6% repayment rate actually returned to the account. This gap compounds further if the borrowed money is never fully caught up through additional contributions after the loan is repaid, meaning the $30,000 disruption to the compounding timeline can easily cost $80,000 to $120,000 in final retirement balance by age 65, depending on how many years remain for the disrupted compounding to have continued. There is an additional risk specific to 401k loans that compounds the cost further. According to research from the Plan Sponsor Council of America, borrowers who leave their job while a 401k loan is outstanding are typically required to repay the full remaining balance within a short window, often 60 to 90 days, or have the unpaid balance treated as a taxable distribution, triggering both income tax and, if the borrower is under 59.5, an additional 10% early withdrawal penalty. The fix is treating the 401k as genuinely inaccessible until retirement age, psychologically and structurally, and building a separate emergency fund and sinking funds for major planned expenses, specifically so the retirement account never becomes the default solution to a cash flow need.
Behavior 4. Paying high expense ratios without realizing it. This behavior is uniquely dangerous because it requires no decision at all. It is simply the default outcome of never checking what you're being charged, and it operates as a permanent, compounding drag on returns that most investors never notice because it never appears as a withdrawal or a line item charge. The expense ratio is the annual percentage fee a fund charges, deducted automatically and invisibly from the fund's returns before they're credited to your account. A fund advertising a 10% return with a 1% expense ratio is actually returning approximately 9% to you every year indefinitely. And because this reduction happens before the return is even reported to you in most contexts, it is one of the least visible costs in personal finance. According to Morningstar's 2024 fund fee study, the average actively managed mutual fund charges an expense ratio of approximately 0.66%, while comparable low-cost index funds such as Vanguard's VOO or Fidelity's FZROX charge 0.03%, or in Fidelity's case, 0.00%. The compounding cost of this difference is dramatically larger than the percentage gap suggests. On a $100,000 portfolio growing at a 10% gross annual return over 30 years, a fund charging 0.03% reaches approximately $1,737,000. The identical portfolio in a fund charging 0.66%, a difference of just 0.63 percentage points annually, reaches approximately $1,453,000. The fee difference, compounding silently over 3 decades, costs approximately $284,000 in final balance, from a fee gap small enough that most investors describe it as basically nothing when they first see it written as a percentage. The fix requires a single check performed once. Look up the expense ratio of every fund currently held in every retirement and investment account, and for any fund charging more than 0.10 to 0.20% without a specific, well-justified reason, such as a target date fund providing automatic rebalancing, replace it with a comparable low-cost index fund alternative, covering the same asset class.
Behavior 5. Chasing last year's top-performing fund. This behavior feels like diligent, informed investing. It is, according to extensive research, one of the most reliable ways to underperform a simple buy and hold strategy. Every year, financial media prominently features whichever sector, fund, or asset class produced the highest returns over the previous 12 months. The behavioral pull to redirect future contributions, or worse, to sell existing holdings and reallocate, toward whatever just performed best is powerful and almost universally counterproductive because of a well-documented phenomenon called mean reversion. Asset classes and sectors that significantly outperform their long-term average in one period frequently underperform in the following period, as the outperformance itself often reflects an unsustainable speculative premium rather than a durable structural advantage. Morningstar's research on fund flows consistently demonstrates this pattern. Investor money flows into funds immediately following their best performing years and flows out following their worst performing years, meaning that in aggregate, investor capital is systematically buying high and selling low relative to each individual fund's own performance cycle. Morningstar's investor return calculations, which measure the actual dollar-weighted return investors experienced based on when they bought and sold each fund, consistently show investor returns lagging the fund's own reported total return by 1 to 2% annually across most fund categories, a gap created entirely by this performance-chasing behavior. A hypothetical investor who every year for 20 years moved their entire portfolio into whichever sector had performed best the previous year would have significantly underperformed an investor who simply held a diversified total market index fund for the same 20 years, according to back-tested modeling of this rotation strategy. Not because identifying strong performers is impossible, but because identifying which strong performers will continue performing strongly rather than reverting toward the average is a significantly harder problem that even professional fund managers consistently fail to solve. The fix is committing to a fixed asset allocation determined in advance, based on your age and risk tolerance, rebalanced on a predetermined schedule, annually for most investors, rather than in response to which category happened to perform best most recently.
Behavior 6. Checking your account balance too frequently. This behavior seems harmless, even responsible. Research on its psychological and behavioral effects suggests it is neither. The phenomenon is called myopic loss aversion, a concept developed by behavioral economists Richard Thaler and Shlomo Benarzi, and it describes a specific, measurable relationship between how frequently someone monitors an investment and how risk-averse their subsequent decisions become. The core finding: the more frequently you check an investment's value, the more likely you are to observe it in a temporary decline, and the more likely a temporary decline is to trigger a fear-based decision, even though the underlying long-term trend of a diversified equity portfolio is positive. The math behind this is straightforward. The S&P 500 has historically posted a positive return on approximately 53% of individual trading days, but a positive return over approximately 75% of calendar years, and a positive return over essentially 100% of rolling 20-year periods throughout its recorded history. An investor checking their account daily will see a loss on nearly half of all checks. An investor checking monthly will see losses considerably less often. An investor checking annually will see losses on a small minority of checks. An investor checking only once per decade has, historically, never once observed a loss. The same portfolio, The same actual investment performance produces dramatically different emotional experiences and dramatically different probabilities of triggering a panic-driven bad decision purely based on observation frequency. Thaler and Benarzi's research specifically found that investors who evaluated their portfolios less frequently were willing to hold significantly higher allocations to equities, because the psychological pain of frequently observed short-term volatility was removed from the decision-making process entirely. The fix is structural rather than willpower-based. Removing investment apps from your phone's home screen, disabling balance notification emails, and deliberately scheduling portfolio reviews on a quarterly or annual basis, rather than allowing unlimited, unstructured access to a number that, viewed too frequently, will reliably trigger decisions that hurt long-term returns.
Behavior 7. Holding too much cash until things calm down. This behavior typically begins as a temporary, reasonable-sounding decision during a period of market uncertainty and frequently becomes a permanent, extremely costly default that investors never consciously decide to maintain. The decision to move a portion of an investment portfolio to cash during a period of volatility with the stated intention of reinvesting once conditions calm down or become clearer requires successfully predicting two separate events: the right moment to exit and the right moment to re-enter. Decades of research on market timing consistently demonstrate that even professional investors with significant resources fail to reliably execute this two-part prediction, and the cost of failing to re-enter promptly is specifically documented. Missing just the 10 best trading days in the S&P 500 over a 20-year period reduces total returns by approximately half, according to research from J.P. Morgan Asset Management's Annual Guide to the Markets. And 7 of the 10 best trading days historically occurred within 2 weeks of the 10 worst trading days, meaning the volatility that triggers the flight to cash is frequently immediately followed by the strongest recovery days. An investor who moved $200,000 to cash during the initial uncertainty of the 2020 crash, intending to reinvest once things calmed down, and who didn't feel confident enough to re-enter until conditions genuinely felt stable again in mid-2021, missed a recovery during which the S&P 500 gained over 80% from its March 2020 low. The safety of cash during this period cost approximately $160,000 in foregone gains relative to simply remaining invested. The fix requires accepting a specific, uncomfortable truth. There is no reliable signal that indicates when conditions have calmed down sufficiently to re-enter, because markets typically recover well before the underlying economic or social uncertainty that caused the decline has actually resolved, meaning that waiting for genuine clarity guarantees missing the recovery that occurs during the period when clarity is still absent. Behavior 8. Failing to rebalance, letting risk drift unchecked. This behavior is the opposite problem from excessive activity. It is the cost of complete passivity applied incorrectly, allowing a portfolio's risk level to drift significantly away from its intended target without any corrective action. A portfolio initially allocated 70% stocks and 30% bonds, left entirely unmanaged through a sustained bull market, will see its stock allocation drift upward over time as stocks appreciate faster than bonds, potentially reaching 85 or 90% stocks after several strong years, without the investor ever making an active decision to increase their risk exposure. Vanguard's research on portfolio rebalancing found that a 60-40 stock-bond portfolio left completely unrebalanced from 1926 through a multi-decade historical period
would have drifted to over 99% stocks at certain points, due to the compounding effect of stocks' higher long-term growth relative to bonds, exposing an investor who believed they held a moderate-risk 60-40 portfolio to a decline essentially equivalent to an all-stock portfolio during the worst market downturns of that period. The fix is a predetermined calendar-based or threshold-based rebalancing rule, reviewing the portfolio annually or whenever any asset class drifts more than 5 percentage points from its target allocation, and adjusting new contributions or executing trades to restore the original target. This is not market timing, it is risk management, ensuring that the portfolio's actual risk level continues matching the investor's intended risk level, rather than silently drifting toward whatever has performed best most recently. Behavior 9. Cashing out a 401k when changing jobs. This is one of the most financially destructive single decisions available to a retirement saver, and it is also, somewhat remarkably, one of the most common, driven primarily by the immediate appeal of receiving a lump sum of cash during a job transition, rather than understanding the long-term cost. According to research from the Employee Benefit Research Institute, approximately 41% of workers who leave a job cash out at least a portion of their 401k rather than rolling it into a new employer's plan or an IRA. And this behavior is significantly more common among younger workers and those with smaller account balances, precisely the group for whom the long-term cost is most severe, given the decades of compounding being eliminated. Cashing out a 401k before age 59 and a half triggers both ordinary income tax on the full distributed amount and, in most cases, an additional 10% early withdrawal penalty, meaning a $20,000 account balance for a worker in the 22% federal tax bracket is reduced to approximately $13,600 after taxes and penalties, a roughly 32% immediate reduction, before any consideration of the lost future growth. That immediate 32% loss is, in fact, the smaller part of the true cost. The $20,000, had it remained invested and continued compounding at a 10% average annual return for the 30 years remaining until a typical retirement age, would have grown to approximately $349,000. The decision to cash out doesn't just cost $6,400 in taxes and penalties, it costs the entire $349,000 in foregone future growth, in exchange for receiving $13,600. The fix is a firm, predetermined rule. Every 401k balance from every job, regardless of size, gets rolled directly into either the new employer's plan or a personal IRA, executed as a direct trustee-to-trustee transfer that never passes through the account holder's personal bank account, specifically to remove the temptation and the tax consequences associated with a cash distribution. Behavior 10. Letting emotions, not a plan, drive every decision. This final behavior is the underlying mechanism that produces every other behavior on this list, and addressing it directly is more valuable than addressing any single symptom individually. Every behavior described above, panic selling, pausing contributions, borrowing against retirement savings, chasing performance, checking balances compulsively, holding excess cash, neglecting rebalancing, cashing out at job transitions, shares a common root cause. The decision was made in the moment, in response to an emotional state, rather than according to a plan established in advance during a calm, rational period specifically designed to govern behavior during emotional periods. Behavioral finance research consistently identifies this as the central challenge of long-term investing. The strategy itself, diversified, low-cost, long-term index investing, is not difficult to understand or execute mechanically. What is difficult is maintaining that strategy through the emotional experience of watching it temporarily decline in value, which is not a hypothetical risk, but a guaranteed, recurring feature of investing in any asset that has historically produced meaningful long-term returns. The single most effective tool against every behavior on this list is a written investment policy statement, a document created while markets are calm and emotions are absent that specifies your target asset allocation, your rebalancing rules, your contribution schedule, and an explicit written commitment to specific behaviors you will not engage in regardless of market conditions, including I will not sell equity holdings during a market decline, and I will not stop or reduce automated contributions in response to market volatility. This document does not need to be sophisticated. It needs to exist, to be written down before the emotional pressure arrives, and to be consulted specifically during the moments when the temptation to deviate is strongest, functioning as a pre-committed version of yourself, making the decision on behalf of the version of yourself who will be tempted to abandon it months or years later during a period of genuine market stress.
10 behaviors. None of them involve choosing a bad investment. Every single one of them involves taking a fundamentally sound, historically validated strategy and actively interfering with it at precisely the moments when interference is most costly. Selling during downturns converts temporary paper losses into permanent real ones. Stopping contributions during downturns eliminates the specific purchases that would have bought shares at their most favorable prices. Borrowing against retirement accounts removes capital from the compounding process at a rate of return far below what the market would have provided. Paying unnecessary expense ratios creates a permanent, invisible drag that compounds against you for decades. Chasing last year's winners systematically buys high and sells low relative to each fund's own cycle. Checking balances too frequently manufactures emotional pain from short-term volatility that has no bearing on long-term outcomes. Holding excess cash until things calm down guarantees missing the recovery that occurs before clarity ever actually arrives. Failing to rebalance allows risk to drift silently beyond what was ever intended. Cashing out a 401k at a job change trades immediate, modest cash for decades of foregone compounding. And underneath every one of these specific behaviors is the same root cause: emotional, in-the-moment decision-making in the absence of a plan established in advance. The market has never needed to be defeated. Investors have consistently defeated themselves at a documented, measurable cost that exceeds anything the market itself has ever inflicted on a patient, disciplined participant. The strategy that works is, by this point, not a secret. Low-cost index funds, consistent automated contributions, a predetermined asset allocation rebalanced on a schedule, a written commitment to specific behaviors during specific conditions made before those conditions arrive. The only remaining variable is whether you interfere with it. The market will do its part. It always has. The only open question is whether you'll let it.